Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. And world on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you guys get it. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good afternoon, everybody, guys. We have the big moment is upon us. We've only got a few minutes here. Oh, you know what? I don't even have financial juice running here. So if you guys are new to Federal Reserve meeting, and especially one where, like this, I just warn you, there is going to be extreme volatility after this event and through the press conference. I would highly recommend against trying to trade this action unless you are a very experienced trader with a very large bankroll, because the amount of risk that is going to be going through here is going to be insane. If I see something that really surprises me, then maybe I could come in and take something in the micros, but otherwise I think that we're going to be mostly just along for the ride here and watching. All right, so we got 2 minutes to go here. How are you guys doing? My son is very upset that, well, he's being watched by grandma right now, and he's very upset that he can't come into the room. Maybe we'll let him come into the room here. Okay, come here. Calm down. You hold him. And sit right there. Look, we're recording, so no crying. No crying. We're recording here, right? Okay. Here we go. 30 seconds. 30 seconds. You watch this. It's gonna go nuts. It's gonna go nuts. So you can see over here. You can see the window. We can kind of see half of you. You look just fine. All right, man. This is gonna be. I'll make sure that I have all of my orders off. Oh, and you know what else? We got to get out of this this sim trade. Okay, here we go. Ooh. Man. Okay. So we're getting both ways here in the treasuries. It is kind of looking upside here. I'm noting that the 6J, the Japanese yen, really taking a hit. Gold really seeming to take a hit here. S&P 500 moving down a little bit. A little too early to call. Treasuries. They were resolving to the upside for a little bit initially, but now they're coming down. I'm waiting on something that shows me the changes. Okay. So they did, of course, increase the basis 25 basis points here. But let's just see. Yeah, don't touch that, please. Don't touch that. This is just super crazy. Oh, grandma's got the puppy. Okay, here we go. So they got rid of sectors most adversely affected by the pandemic have improved in recent months. They got rid of that. Inflation remains elevated, reflecting supply and demand imbalances. They got rid of the economy have continued to contribute to elevated levels. So they got rid of all that. Energy prices and broader price pressures. The invasion of Ukraine by Russia causing tremendous human and economic hardship. The implications for the U.S. economy are highly uncertain. They got rid of the paragraph about trying to achieve maximum employment and inflation at a rate of 2%. They got rid of that. And they're just saying events are likely to create additional upward pressure on inflation in a way. And then this paragraph, they really changed. The committee seeks to achieve maximum employment. Oh, okay. So they just kind of moved this down. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run with appropriate firming in the stance of monetary policy. The committee expects inflation to run to its 2% objective in the labor market to remain strong. In support of these goals, the committee decided to raise the target range for the federal funds to a quarter to 0.5% and anticipates ongoing increases in the target range will be appropriate. In addition, the committee expects to be increasing its holding of treasury. Begin decreasing. I think the way that they did the red there is a little confusing. To begin decreasing reducing. Oh, I see. To begin reducing its holdings of treasury securities. But then it doesn't say by how much. Voting against this action was James Bullard, who preferred at this meeting to raise the target range for the federal funds rate by 0.5 percentage point to 1/2 to 3/4. Now that I did not expect. I don't know. So that is maybe a little bit more hawkish, but that's about the only thing. Should we be involved right now? I don't think so. I don't know if we really should be. Okay. So I mean, I could see some reason to be hawkish here, right? You okay, bud? Yeah. It's not that interesting though for little babies, is it? No. I think that the general move that I'm seeing here in the markets is appropriate for what the move was. Of course, we should just expect to see just a lot of volatility in general, but resolving to the downside, I think, yeah, that's right. Now the 30, and let's see here. Where are we at? I can't even really see. Oh man, are all of the micros busted here? I think they are. Okay, I'm gonna have to do something. You're gonna have to take him now. Go see mommy. Put the puppy down there. Go see grandma. So I am seeing here the treasuries are moving like crazy, and I'm not well. Okay, there are some offers out there. But look at the spread. Like, talk about insanity. So I'm kind of thinking we probably can try to move things up a little bit here. So the 30-year at 2.5% now. You think the market was too optimistic? Yeah, I don't know. I think that the press conference is going to be more instructive here, but President Biden says, as soon as I deliver remarks at an event celebrating the reauthorization of Violence Against Women Act. Okay. That's weird. And I thought that letting him in here would calm him down, but then now he's just like freaking out again. Man, okay, so the 30-year is handling this pretty well, but the 5-year is not at all. Anybody want to cross the bridge there, huh? No? Hey, I'll do, let me do 2? Okay. All right. Maybe. There we go. Okay. Do you see that? On the DOM, if I put my order there, another big one shows up. Oh man, the 5-year is just busted. All right. Just can't even bother trading those ones. Yeah. So the micros are basically at the moment untradeable. In order for the market making robots to try and come back, somebody would probably have to start offering at 22.5. It ain't gonna be me. So even though we had like this really big move down, don't underestimate the possibility of it completely coming back because of the liquidity conditions and everything else. That's entirely possible in this kind of situation for it to come all the way back. So I'm not going to be coming in and just hitting into 23 thinking this is just going to go, right? I would love to see. It looks like some people did trade off of the event though, like, which is actually pretty funny. Somebody hit with 51 contract. Okay, so you can kind of see somebody else was trying it too, right? So what I've found is that the market making robots will not turn on if the spread is like too wide. So that's why you're seeing this. Like if somebody puts an order at well, I think it would need to be more like 20. Then you see how a large order shows up at 20.1. And then it canceled. Okay. And then I cancel mine and then it goes to 18.6. Well, whatever. Whatever. Stop everyone out with wild swings twice. Well, the S&P 500 is pretty unhappy at the moment, right? I took that trade off. I was short. Could still be short. Would have been good. Yeah. Well, let's see what's going on over here. Ooh. Oh, that's yeah, that's interesting. That's actually not too big of a change. I've been watching some of the small caps today, like the one, the one of my investments, Sumo Logic. And it had a pretty good jump today, actually. It had a really, really good jump today. But it's fluctuating around quite a bit here now too. But it really looks like a massive. Okay, you saying that we got a negative 1,000 on the tick? We're getting some sort of really massive sell program coming through here at the moment, right? I always think this thing is kind of funny because, like I said, the only thing in that statement that I really picked up on as being critical was that Bullard wanted to raise it more. So if let's come over to the Fed tool. Let's come over to the Fed tool while this is going. And we got 20 minutes till the press conference. So while the press conference comes on, I'm going to have to turn the camera off. So we'll just only watch the video. Putin is dumping? Yeah. I don't think that he has the ability to trade anything right now. Okay, so if we come to the CME Fed Watch, Discord is already falling for you? Okay, so if we come over here, I don't know if it's changed yet, but okay, yeah. So the May expectation was a few days ago was like 40-50. I think that this is probably going to go more to like 70-80% now. That Bullard really wanted one already, and yeah, he's definitely going to want it in May. But the commentary that we get from Powell could change that, right? What they doing now? Yeah. Oh, that's interesting. Oh, you know why? Because I didn't put, should just be a limit order here. Dang. I guess not. I guess I'm not going to do it. The 5-year is just a disaster. Is there anybody even putting offers on the 5-year? Good grief. The 30-year is handling it well. So this is some really extreme flattening. The 5-year is having a little bit of a pullback. So you can just kind of see at the moment, the markets are so dislocated and the liquidity is so light that the treasuries aren't even able to keep their correlations in very well. I suppose that some of that is going to be like mean reversion steepening coming in here. Okay, so most Fed officials see as many as 7 rate increases in 2022, tweets Walter Bloomberg. You think NQ could dump another 200? Well, it would certainly be interesting to me to see what would happen if they got back to like the 4250 area in the S&P 500. But like I said, you can be really careful about reading too much into the immediate reaction to the actual FOMC statement, right? Because this is an impulsive move, and really you're going to see a lot of, it's moving down, and so everybody else says, oh, this is really bad, when it might not actually mean a whole lot, much of anything, Let's just remember that the markets are not financially efficient. I think it's so funny. People trying to read so much into just a few little changes in the statement. If anything, I think that the statement is a little bit more dovish than it should be. And let's see what kind of headline Zero Hedge has up right now. Announces hawkish 25 basis point rate hike, sees rate overshoot in 2024. Bullard dissents. Bullard dissent, I think, is a key thing there, right? Looking at 5-minute candles, there's no good thing yet. Dude, the 5-year is just hilarious. The 2-year is just hilarious. I really wish I had a Bloomberg terminal. I would totally put orders up on there. I think in this situation we could put orders up there if we had something that tell us accurately what the interest rate should be at the moment. Yeah, some big order there at 150.25 in the 30-year. The 30-year just kind of took a little bit of a plunge and caught up there. Seco Smalling. So the market is selling off today on information that was known for months now. You could put it that way. We didn't know that Bullard was going to dissent. That's the most significant piece of new information that we have here, is that there was one member of the Federal Reserve that really did want to do the 50 basis point hike. And you know what? There was a long time where the market was pricing in that there could be a 50 basis point hike. And then the Ukraine thing happened, and they kind of all gave up on it. And now it comes back through that, oh yeah, he still wants it. So remember, markets are not informationally efficient. What moves the market? Orders move the market. When you have a situation like this, it doesn't matter what they're going to say. It doesn't matter what is in the statement. There are going to be people that are going to be clicking their mouses. They just can't help it. That's just the nature of things. This is such a key piece of information. Everybody that's involved in the market is looking at their computers right now, trying to sort out what they want to do based on this information. So even if there's no actual real information, they'll do stuff. You know what I mean? So, but it's a pretty good move down, and you know what? Based on how far it's moved, man, my son is just really upset. And given how strongly the treasuries moved down, you know, you really kind of have to wonder what the chances are of it coming all the way back. It's got to be a lot diminished. It's just such a strong move. But the market made a pretty decisive and quick move to where it has. And I have to say, if anything, the other markets are underreacting based on how far the Federal Reserve, how far the treasuries moved. So Bitcoin in particular is barely anywhere from this. If they were really going to make a trade, I think that you sell Bitcoin. But the Bitcoiners, they don't necessarily understand that, so they're not going to move. Gold is coming back to 1900, so they might chill there for a little bit. S&P 500 is getting a pretty strong pushback here. So the weird thing, volatility was suppressed all day before the event, like nobody wanted to hedge. Well, I think that they've been hedging all week though, man, right? Like what do you think has been with this 2-3 day rally that we've had in the S&P 500? It's been pretty crazy, right? I'm sure that a lot of that had to do with the Federal Reserve meeting. I'm sure that a lot of people had shorts on that they decided to get out of before the Fed, which I don't know why you would, but whatever. I had that short position from earlier in the day that was based on the Ukraine headlines and everything. The prices that we're at right now in the S&P 500 are what I expected to have happen based on the Ukraine headlines, because we thought that move up was all Ukraine, right? We thought that move up was all Ukraine. Clearly there was a lot more to it than that. But now with the Federal Reserve meeting and the market largely interpreting this as extremely hawkish, we're now coming to those prices, which is pretty crazy. I wouldn't touch a Bitcoin with a 1,000,000-foot stick right now. Well, the 10-year is almost to 2.25, which is basically a 25 basis point rise just in the last week. This is pretty. This is all pretty bonkers, man. I really should have come in and just had a micro contract long from 2.2. Uh-oh, is there a meeting? Is there a meeting? I'm going to come back over here. Oh dear. I'm going to have to go and check. When is that? I don't think I have that on my calendar. Well, the Treasury is they continuing to slip here. The pace of the tape, at least, is quite a bit more tame now. And the actual delta change from all of this is pretty weak for an FOMC, actually. So we might I would keep an eye out for like some massive absorption down here somewhere, right? And the S&P is just kind of turning in on itself, so I don't think we can quite sort out what they're going to do yet. Just filtering through Twitter here. "2022 end rate hike of 1.9% implies 7 hikes in 2022 from 3 hikes in the prior forecast." But that's actually less than like what the Fed tool has been saying, right? I don't know. Okay, ES is kind of heading down to the bottom there again. By the way, dollar, why? Like massively higher. Massively higher. Really makes you wonder though, where do we go from here in the Treasury? Because this is just getting demolished. Let's come back out to like a daily ZN, like 123 is pretty low. Well, okay, so like if we go back to the rise from before, 124-ish area is kind of a nice area. 123 is also interesting to me. This really is like obscene, really obscene volatility in the treasuries. There looks like they're pulling out a little bit more of a bull run. Do you see that iceberg at 28 there buying? The 5-year is still like totally out of whack. The 2-year is above 2%, which is a little scary to me. I don't know where they're really, I mean, since there's no offers out there, I don't really trust that price, but oh, and there's an offer right there. 2.11. Ugh. We're only like 10 basis points off of a yield curve inversion, guys. That's pretty scary. Look at this. 11. Oh no, it's not 11. It's 8. 08 half versus what's on the other side? 08 half versus, yeah, like 8 basis points spread on the 2-year micros. What? Okay. Whatever. Russian forces have released the mayor of Melitopol. Is that how you say it? Recession confirmed? I don't know. I don't know, man. Dude, the speech could be completely different. Like, I'm just along for the ride. I mean, I'm not even along for the ride. I'm just spectating here. I have no clue what comes next. That was a pretty wild move, though, wasn't it? Pretty wild. Advisor to Ukraine's president: Russian soldiers have freed the mayor. Okay. Yeah, okay. All right. Seiko thinks we're heading towards a recession. I'm not entirely convinced, to be honest with you. So here's why I say that. Yeah. Okay, first of all, I don't see anything in the economic data that we have to have a recession here. It's certainly on the table now. Goldman was saying 35% chance of a recession or something like that. That's a relatively high amount, but at the end of the day, it's at the end of the world. No. Okay. But I can remember many times, the trade war, the Euro crisis, the flash crash, and really every other year we'll have one of these market events where the market just really falls apart and then everybody buys a dip and it's fine, right? And the Ukraine crisis, I think, is a very different sort of a thing because it does appear to be leading to a changing world order, at least so far. But that could change really, really quickly, And so I just feel that overall, I can't wed myself to any one position reliably right now, Whatever position you take, it's like you're just going to see a lot of volatility, right? Well, the treasury's coming back up quite a lot. Like, that's not just like I'll come back into the liquidity hole sort of a thing. That's like short covering and probably some buying and stops and stuff, which is kind of interesting considering that the ES is basically testing new lows again. Putin is your daddy. How do you buy? I don't know. I don't know how you short or buy the ruble. Where you would do that? You do it on Forex, maybe? I don't know. Probably some exotic instrument somewhere that I don't have access to. Probably not actually that exotic. It might just be on your typical Forex platform. Them equity traders, they don't look very happy. Okay, so now we should be getting the Federal Reserve here. So I'm going to bring them up. I'm going to get rid of me. I'm just going to turn me off here. There we go. Let me turn his volume on here.
At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability.
How we doing on levels?
The FOMC raised its policy interest rate by 1/4 percentage.
I think I want to be at least.
The economy is very strong, and against the backdrop of an extremely tight labor market and high inflation.
I can only imagine the spreads on ruble pairs right now. Yeah, I don't know if that's. I think that trade is kind of come and gone.
In addition, we expect to begin reducing the size of our balance sheet at a coming meeting.
Okay, so they didn't say anything about the size of the balance sheet.
5.5%,
That's he was just addressing that right there.
reflecting progress on vaccinations and
They took it out of that statement, and I guess that means that they're going to do it next time.
and the healthy financial positions of households and businesses. The rapid spread of the Omicron variant led to some slowing in economic activity early this year. But
They've kind of changed their setup a little bit. They've got different lights on him
seems to
now.
have been mild and brief.
Maybe a little bit.
Although the invasion of Ukraine,
I think you need a little bit.
represent a
I
downside.
don't know, a little too glowy. Kind of, he looks glowing.
FOMC participants continue to foresee solid growth. As shown in our summary of economic
They continue to see solid growth.
projection for real GDP growth stands at 2.8% this year, 2.2% next year, and 2% in 2020.
Well, I don't think that their growth projections are what the market is projecting right now.
And is extremely.
My voice is
Over
cracking.
the first 2 months of the year, employment rose by more than 1 million jobs. In February, the unemployment rate hit a post-pandemic low of 3.8%, a bit below the median of committee participants' estimates of its longer run.
Them means angry.
The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. As a result, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. FOMC participants expect the labor market to remain strong, with the median projection for the unemployment rate declining to 3.5% by the end of this year and remaining near that level thereafter. Inflation remains well above our longer-run goal of 2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. These supply disruptions have been larger and longer lasting than anticipated, exacerbated by waves of the virus here and abroad, and price pressures have spread to a broader range of goods and services. Additionally, higher energy
It's kind of funny to watch the markets
inflation,
rattle around when he's talking, huh?
prices of crude oil and other
Solid growth, anything around 3% is good, yeah.
will
these
put
days.
additional upward pressure on
Obama could never get 3%, right? Remember everybody told Donald Trump 3% will never happen?
Inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We know that the best thing we can do to support a strong labor market is to promote a long expansion, and that is only possible in an environment of price stability. As we emphasize in our policy statement, with appropriate firming in the stance of monetary policy, we expect inflation to return to 2% while the labor market remains strong. That said, inflation is likely to take longer to return to our price stability goal than previously expected. The median inflation projection of FOMC participants is 4.3% this year and falls to 2.7% next year and 2.3% in 2024. This trajectory is notably higher than projected in December, and participants continue to see risks.
You almost confused the March versus April contract? For which instrument?
Monetary policy actions have been guided by our mandate to promote maximum employment and
So how much money did I lose in my regular account off of that?
our policy has been adapting to the evolving economic environment.
It's not that bad,
Continue
actually.
to do so. As I noted, the committee raised the target range for the federal funds rate by 1/4
that bad.
percentage point and anticipates that ongoing increases in the target range will be appropriate. The median projection for the appropriate level of the federal funds rate is 1.9% at the end of this year, a full percentage point higher than projected in December. Over the following 2 years, the median projection is 2.8%, somewhat higher than the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Reducing the size of our balance sheet will also play an important role.
I do see, though, that the small caps got hammered quite a bit there.
At our meeting that wrapped up today, the committee made good progress on a plan for reducing our securities holdings, and we expect to announce the beginning of balance sheet reduction at a coming meeting. Making decisions about interest rates and the balance sheet, we will be mindful of the broader context in markets and in the
Does that mean that they still have disagreements on how to do it?
support financial and macroeconomic stability. As we noted in our policy statement, the implications of Russia's invasion of Ukraine for the U.S. economy are highly uncertain. In addition to the direct effects from higher global oil and commodity prices, the invasion and related events may restrain economic activity abroad and further disrupt supply chains, which would create spillovers to the U.S. economy through trade and other channels. The volatility in the financial markets, particularly if sustained, could also act to tighten credit conditions and affect the real economy. Making appropriate monetary policy in this environment requires a recognition that the economy often evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. We are attentive to the risks.
They want to print more.
Upward pressure on inflation and inflation expectations.
I don't know if that's the case. I think that he's kind of
take the measures
a little bit hawkish
necessary
at heart.
stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
I'm sure that there's going to be some comment here in this that the market's going to read a ton into. Like it's been happening a lot, and I think that you're really
I wonder if you
likely to
could
see that now.
detail your thinking a little bit about how you're considering the risks of going too fast and potentially tipping the economy into recession, and how you're weighing those risks against the possibility of going too slowly, allowing inflation to become embedded and kind of getting behind the curve.
So, I guess I would start by saying that, in my view, the probability of a recession within the next year is not particularly elevated. And why do I say that? Aggregate demand is currently strong, and most forecasters expect it to remain so. If you look at the labor market, also very strong. Conditions are tight, and payroll job growth is continuing at very high levels. Household and business balance sheets are strong. And so all signs are that this is a strong economy, indeed one that will be able to flourish, not to say withstand, but certainly flourish as well in the face of less accommodative monetary policy. So I guess that's how I would say I'm looking at that. Of course, the objective is to achieve price stability while also sustaining a strong labor market, and that is our overall objective. But we do feel the economy is very strong and well positioned to withstand tighter monetary policy.
Okay. Not everybody agrees with that one. That the market sentiment does not agree with them.
I was wondering, in the
Right.
steps, you have quite a markdown to GDP from 4 to 2.8%. I'm wondering, how much of that do you feel is a result of the Fed's stiffer than expected action here? You talk about monetary policy operating with a lag, but is this going to bite quicker than expected?
I don't think that's a
Okay.
big piece of it, actually. I think some of that is just an early assessment of the effects of spillovers from the war in Eastern Europe, which will hit our economy through a number of channels. Highly uncertain, but
How is our unemployment rate so low, but businesses are struggling to fill positions because they don't pay people enough and because their hiring process is too strict?
So that's part of what moved those assessments down. I think generally monetary policy works with a lag, so some of that would also be in there. But remember as well that 2.8% is still very strong growth. If we think that the potential growth rate of the economy is
Dollars coming back down there a lot, and the S&P 500 is
strong economic,
relaxing a
one of the
lot.
strongest years, in fact, of the last expansion. So while it's lower than last year's 5.8%, it's still quite strong growth. So I would say it's quite a strong forecast.
So in that context, what would trigger you to go faster or slower on the rate hikes? Ongoing increases doesn't really tell us whether this is going to come in bigger chunks or evenly paced through the year.
So
Just ask, are you going to raise 25 basis points next
Every meeting is
time?
a live meeting, and we're going to be looking at evolving conditions. And if we do conclude that it would be appropriate to move more quickly to remove accommodation, then we'll do so. I can't be perfectly specific about it, but that's certainly a possibility as we go through the year.
Thank you.
Is a bull market possible during World War III?
In post. Thank you, Michelle, and thank
Yeah,
you.
ask him that one. It's
I'm curious if you can be specific on when you expect to see inflation will start to come down, especially with the combination of
get the microphone closer to me here.
fiscal aid dissipating from the economy and supply chains getting better. And if you don't start to see that, how will you signal it? What will you be looking for, and what will you be looking for over the course of the year? Thank you.
So I guess
It kind of looks like they're coming settling back into a kind of a small liquidity hole that they created on the way down.
Back to that. I would have said that the expectation
I don't know if that's going to be a strong enough one to stop them here.
sometime in the first quarter, maybe the end of the first quarter of this year, and then maybe stay at that level or a little bit lower, and then start to come down in the back half of the year. So now we're already seeing a little bit of short-term upward pressure in inflation due to higher oil prices.
Look at that.
Natural gas a little bit, but not so much for us since we have our own natural gas supply. Other commodities prices. The other thing is that
well, it doesn't look like the treasuries are going to come back, but the equities certainly might.
Lots of countries and companies and people not wanting to touch Russian goods. So that's going to mean more tangled supply chains. So that could actually push out the relief we were expecting on supply chains generally. So I guess I would say that the expectation is still that inflation will begin to come down in the second half of the year. But if you look at where I read the SEP headline median, we still expect inflation to be high this year, lower than last year. And then we expect that, particularly with the effects of the war, but also the data we've seen so far this year, we expect inflation to remain high through the middle of the year, begin to come down, and then come down more sharply next year.
So the 6J has recovered a lot of its losses, but the equities, or sorry, the treasuries are still kind of sad.
Chair Powell, over the last 6 months, the Fed has shifted its policy stance quite a bit. 6 months ago, you were still buying assets. Most officials weren't projecting any interest rate increases this year. And yet, despite the shift over the last 6 months, real rates are as negative today as they
Well, I think that the equities may have overreacted initially anyways, right?
Surprises.
When he comes in and he's like, here's what our economic projections are, and they're really good, that the equities kind of chilled out, didn't they?
Stay at levels that do not actually provide much restraint to the economy. Thanks.
So that's one of many ways of capturing the situation, which is that the committee really does understand that the time for rate increases and for shrinking the balance sheet has come. And I would just say, I would go back to the economy is very strong. As I mentioned, tremendous momentum in the labor market. We expect growth to continue. It's clearly time to raise interest rates and begin the balance sheet shrinkage. And I just wanted to say that as I looked around the table at today's meeting, I saw a committee that's acutely aware of the need to return the economy to price stability and determined to use our tools to do exactly that. You couched it in terms of real rates. I would say if you look at the SEP, you've got people.
So interesting to me, it seems like he is more concerned about the market knowing that he's serious. Like, he's more concerned about pushing against the people that are saying, oh, the Fed isn't going to actually raise rates. They're full of it. He's more concerned about sticking it to those guys than he is sticking it to the guys that are like, there's going to be a recession.
It's going to happen, but we do know that we're going to deploy our tools to achieve our goals, and that includes the price stability goal.
The way the Treasury is trading here is exactly why I hate trading during the press conference. It's like 3 or 4 ticks up or down, pretty random.
You all have inflation coming down over the course of the year to 4.3%. And then you also have rates going up to what appears to still be below roughly what would be estimated to be the neutral rate, although I know that's a little bit uncertain. So I was just wondering, how much of inflation coming down do you see as actually being as a result of the Fed itself raising rates? And then also, if I could just ask, given that Sarah Bloom Raskin withdrew her nomination, what do you expect to do with the regulatory portfolio? Do you expect to assign a governor in charge of that?
Okay. So sorry, tell me again your first question.
My first question is, how much do you expect inflation to come down as a
Okay.
direct result of the
The
Fed?
market can read the Fed is full of it. I don't know about that.
Okay, so part of inflation coming down at the very beginning is clearly to do.
I think that traders are just going to trade. That's what I think.
And those would include potentially the supply chains getting a little bit better. Certainly base effects. You're lapping, as you know, when you look at a 12-month trailing window, you're lapping very high inflation in March, April, May, June of last year. So there should be some effects from that in the 12-month picture. Really what we're looking for, though, is month-by-month inflation coming down. And so it's really, it's all the things we've been talking about, that really haven't helped much, including the shift away from goods and back to services, including supply chains getting better, including labor force participation, all those things that have been sticky and not happening. But a big part of it is the base effects I mentioned as well. I think monetary policy starts to bite on inflation and on growth with a lag, of course. And so you would see that more in 23 and 24. But also remember, we started talking about rate increases last year. For some months now, financial conditions have already incorporated a significant number of rate increases. So it doesn't start today. In effect, the moves are already priced into the market for a few months now.
Yeah.
So the clock is running on that, and I think some of that will be seen in the second half of the year as well. And on the regulatory portfolio, I would just say this: we have an obligation to carry out under the law, in supervision and regulation, and we're doing that. That's what we're doing. The committee is
Treasury's coming back up here a little bit. You think it had anything to do with him saying this is already priced in?
We got the stress tests done. We've looked at it, a number of proposals for mergers and things like that. So we're working ahead. Of course, we don't have a vice chair for supervision, as you mentioned, but we're making do with the situation we have, and a good number of things have come straight to the board for approval.
Well, he is right that the rates already reflect the Federal Reserve actions pretty well. In fact, the market might even be a little bit ahead of the Federal Reserve. So I don't know, man.
Thanks for taking our questions. In the statement of economic projections, we see a forecast of median 1.9% Fed fund rate at the end of the year, 2.8 end of next year. Wondered whether that aligns with your own expectations, in particular on that point of overshooting the long-term neutral rate.
So why are they all turning their cameras off when their face is off of Powell and then turning it back on? What's with that?
So I don't, Neil. I've never talked about my own SCP projection. It's in there, but I think Fed chairs have generally not done that because we just haven't done it. It's because we have to put together the
we just haven't done it.
consensus on the committee and present that consensus. So I wouldn't talk about my individual one. And in terms of the pacing of it, I would just point out that is there's 7 remaining meetings this year. This isn't something we discuss or debate.
How hard do you think the treasuries can come back? You think they can make it all the way back up? There's a big order there to for
the shrinkage of the balance sheet, which people do the math different ways, but that might be the equivalent of another rating.
I'm kind of interested in playing that one.
The runoff of the balance sheet. So I don't know. We haven't made any decisions on front end loading or going steadily through the year. And as I mentioned,
Yep.
If you look at the SEP, a good number of participants do see more than 7 rate increases this year. And I can't give you, I'm not going to try to give you a really specific test for
I got a really poor spot in the queue when I tried to stack there.
At the data as they come in, we'll be looking to see whether the data show
14 moved up there at 06.
inflation. We'll be looking at the inflation outlook and making a judgment. And we'll be going, each meeting is a live meeting. And if we conclude that it would be appropriate to raise interest rates more quickly, then we'll do so.
Did you see the image there? We're having some technical problems. Who's in charge of the OBS there? He's just sitting there waiting. Is there probably somebody's asking another question and we can't hear it now? That's my guess on that one.
1 second.
Okay. Okay. Cool.
One more time. Colby Smith at the FT.
They are having technical problems for sure. This is awkward. Treasury
Colby. Let's go to Edwin.
Treasury market rallies on technical issues.
Yeah, thank you, Chair Powell. Thank you, Michelle.
Whoa.
I have a more
Whoa.
question. The last time the CPI inflation, I know you look at PCE, but CPI inflation was as high as it was July of 1981 when the effective federal funds rate was 19.2%. But given the current
There's
data,
some strong
how far
extortion
behind
on the bid there. That's a good trade.
do you believe the Federal Reserve is in your mind?
I had to do multiple contracts to sort it out, but that was a good trade.
We have the tools that we need, and we're going to use them. And as you can see, we have a plan over the course of this year to raise interest rates steadily.
The guys on Twitter are saying, any lip readers? I think he said buy.
We'll take the necessary steps.
Did the Fed pay the Zoom bill?
While also supporting a strong labor market. And as I mentioned, if we conclude that it would be appropriate to move more quickly, we'll do so. I leave it to others to make the judgment you ask for.
And then just as a follow on that, I wanted to get you on the record on this. What impact has there been on your job?
Hold on a second, I'll be right back.
We lost you in the middle of the question.
Edward, can you repeat that question?
The impact that given you're not actually confirmed and Governor Brainerd is not actually confirmed, has there been any impact on your job or the Fed's ability to handle inflation?
None whatsoever.
Okay, let's go to Colby Smith at the FT.
Thank you, Michelle. Chair Powell, how concerned is the committee about the notable pickup in services inflation, which is perhaps less likely to self-correct? And to what extent does it alter both the committee's confidence that long-term inflation expectations will not de-anchor in the coming months?
Not only was that a good trade, but they blew right through that, didn't they?
Further above neutral than indicated in the dot plot. Thank you.
Thank you. So
yeah, I got 0-4 high.
We're watching report by report, and we're certainly we noticed it in the last meeting, and it's part of the overall picture. We have expected services.
This is kind of the fun thing about order flow during these meetings is that you can't, I mean, it's like really high risk, but every once in a while you can get a really strong order flow read, right?
Before the crisis. In other cases,
those big orders just stick out like a sore thumb. It's really hard for them to hide it in this kind of action.
It's concerning. In the meanwhile, we see some progress on the good side, but really in this latest report, it was confined to vehicles, which is admittedly a large category. So, as I mentioned, the committee acutely feels its obligation to move to make sure that we restore price stability, and is determined to use its tools to do so.
Thank you. Let's go to Steve Leisman at CNBC.
Man, Steve not coming in until 30 minutes into it, huh?
I wonder if you could help me understand the kind of logic, if there is one, inside the SCP here.
He did not say that.
The median forecast, for example, for unemployment, it runs for the 3-year window below the long run rate. I look at inflation.
Whoa. Did they just cut him off? What was that? What just happened?
It's all true in a regime when you run at least for 2.
What just happened?
Above the long run rate. So I guess my question is this: are you not give a forecast here that essentially suggests you will be continuing to run further behind the curve and never really get in front of inflation because the economy will continue to run hot? And kind of on a related issue, you said earlier, inflation will take longer to return to price stability than we had originally expected.
Well, look at that big order they just he just showed his hand.
Let inflation run above price stability longer than you'd like.
It's like, dude, I got 3,000 contracts. Help me out here. No, I don't think so. I think you just buy it.
But understand that there's no, it's not something we voted on. It's not a plan. But if you look, people do have.
Oh, come on, that didn't fill? Really?
By the end of this year,
That's a little better.
broadly, people are at or close to, or in some cases above, their estimates of longer run neutral interest rate. Okay, so that should stop pushing. That should, in other words, that should be.
He might have just panicked there and got his fills on all of that noise that we just had there.
And you can think of that as further. In the next year, and just you're now above above the what people estimate to be the longer run median. So and also in many people's forecasts, that actually amounts to tight policy in real rates as well. So why does unemployment remain at 3.5%? I mean, a couple points. One is the connection between in the economy we had before the pandemic, the connection between inflation and the level of the unemployment rate was not very tight. But this is clearly what this is an expectation that really it amounts to the idea that wage increases, which are now running above the level that would be consistent over the long run with 2% inflation, will move back down to levels.
Probably shouldn't have taken 3 there.
Attractive, full economy full employment kind of wages, but not to a point where they're pushing up.
I think that I had a good setup there, but I wasn't fast enough on that one because I should have already been out when they were hitting into 11 and 11.5.
And the reality is there are many moving pieces, and we don't know what will actually happen. But no matter what happens, this is a committee that is determined to use its tools to make sure that higher inflation does not become entrenched. And so we are determined on that front, and we'll deal with what comes. This is a modal or most likely expectation, but we'll deal with what comes, whether it's better or worse.
Thank you. Let's go to Chris Rugaber at the AP.
Hi, thank you. Well, let me follow up a bit on that. I mean, there are a lot of economists skeptical that you can reduce inflation as much as you've penciled in without raising the unemployment rate. And I'm wondering just what are the you see in reducing demand? I mean, outside housing and autos, how do higher Fed rates reduce consumer demand unless it's through higher unemployment? Thank you.
If you take a look at today's labor market, what you have is 1.7 plus job openings for every unemployed person. So that's a very, very tight labor market, tight to an unhealthy level, I would say. So in principle, if let's say that our tools work as you described, and the idea
this is the Treasury market close is what you're seeing right here. So I was wondering, I was like, all of a sudden getting a lot of volume. What's going on? Oh, it's 1 o'clock.
The number of job openings so that they were more like 1-to-1.
I always miss that one.
Pressure on
There's just such a weird time, but that was definitely the pick close. So maybe that move they were signing up was
hire enough people.
Somebody realizing how screwed he was and just trying to bail.
That's really the thinking there. Is these are fairly well understood channels, interest sensitive, and basically across the economy, we'd like to slow demand so that it's better aligned with supply, give supply at the same time to recover, and get into a better alignment of supply and demand, and that over time should bring inflation down. And I'll say again, though, we don't have a perfect crystal ball about the future, and we're prepared to use our tools as needed to restore price stability.
AKA, we will lower employment if we have to.
Really can't have a sustained period of maximum employment. It's
the rate increases will continue until morale decreases.
In this case, price stability. So we're very committed to that. Of course, the plan is to restore price stability while also sustaining a strong labor market. That is our intention, and we believe we can do that. But we have to restore price stability.
But we have to. You hear what he said,
Let's go to
right?
Scott
That's
Horsley at NPR.
you can read between the lines, but he's saying, yeah, we'll hurt unemployment if we have to. We don't think that we have to, but we'll do it if we have to.
Some of the same ground you just talked about, Mr. Chairman. I think I missed some of your answer there, but I have a follow-up question on the labor force. We have seen some gains in the prime age workforce in the last few months. I wonder what you anticipate when it comes to some of the older workers as the health outlook has changed. Are we going to see more recent retirees following Tom Brady back in the workforce? And what would that mean for inflation?
It's hard to say. You know, what we saw in the last cycle was that over the course of a long, steady expansion, labor force participation outperformed.
I'm okay with just having a browser window in the corner. It's nice and easy for me.
It was a tight labor market, but it was nowhere near.
I kind of like just using the hack. You know, like when I make my TikTok videos, like I could go in and edit it. I went in and it did that once, and the video didn't do as well. It's more fun to just record my screens.
In the aggregate, very much, but. So that's what was happening. And, you know, more labor.
Yeah, the labor market is so tight, it's unhealthy. That is kind of hawkish.
Our policy does not in any way preclude that. This is a situation where wages have moved up at the highest rate in a very long time. And people are able to quit their jobs and move to better paying jobs in the same industry or different industry. So it's a really attractive labor market for people. And once, you know, as we get past COVID, well and truly, it becomes an even more attractive one. So we hope.
Well, on this gambling trade here, I think that I've tried to hold on to that one long enough, so I'm going to flat there.
Some of the wage pressures that do put inflation more at risk. That last part is we'll have to see whether empirically it works out that way. But you know, in principle, it ought to help with inflation as well. It's not the only thing we're looking for, though, from inflation. We're looking for help.
I think that was way worse than the original buy that I had. Yeah, but it was more contracts.
From our own policy.
Okay, let's go to Rich Miller at Bloomberg.
Thank you, Michelle, and thank you, Chair Powell. I'm sorry, I'm having some communication problems, so I've missed some of the stuff you've said, and my apologies if this has been asked. Since the FOMC met last January, financial conditions have tightened markedly. Equity prices down, treasury yields up, bond spreads risen, yield curve has flattened a lot, and even further today, dollar is up. Is that welcome? And would you like to see more in order to achieve your goals? Thank you.
So as you know, policy works through financial conditions. That's how it reaches the real economy by just the mechanisms you mentioned. And remember that the financial conditions
Biden says Putin is a war criminal, huh?
A function not only of very aggressive and appropriately so fiscal policy, but also highly accommodative monetary policy. The monetary policy settings that we put in place at the worst parts of the pandemic. So it is very appropriate to move away from those. And yes, that will lead to some tightening in financial conditions in the form of higher interest rates and just the sorts of things. We're not targeting any one or more of those things, but financial conditions generally should move to a more normal level so that because we know the economy no longer needs or wants these very highly accommodative this stance, which, you know, so it's time to move to a more normal setting of financial conditions, and we do that by moving monetary policy itself to more normal levels.
When you say move to a more normal setting for financial conditions, that suggests to me that you want financial conditions to tighten further from where we are now. Am I drawing the right inference from that?
Well, yes. So I would say we
yes.
have a broad range of financial conditions. and of course, when we tighten monetary policy, we do expect that they will adjust in sync over time with monetary.
S&P 500 is handling this really well, guys. I have to say, of course, my trading here is just gambling out. And every once in a while, you get a good order flow signal. That second one, I was too slow on. This one right here, I don't know if I'm really getting a good signal or not.
So that it's at least less accommodated.
But
broader financial conditions will.
Equity index is doing pretty well.
Thank you. Just a little housekeeping note. Those of you in this call may be having some tech issues. If so, I understand the broadcast is coming through clearly on www.federalreserve.gov. So you might go there for the audio. And now we'll go to Jean Young.
Hi, Chair Powell. I wanted to ask about the balance sheet discussion you've had at this meeting. Can you give us any more details? Did you discuss whether to cap runoffs or whether to increase those caps over what period if they were?
So what he says here might be
Yes,
important.
thank you for asking. So at our meeting,
Thank you for asking. He's been waiting. He's been waiting.
Toward agreeing on the parameters of a plan to shrink the balance sheet. And I'd say we're now in a position to finalize and implement that plan so that we're actually beginning runoff at a coming meeting, and that could come as soon as our next meeting in May. That's not a decision that we've made, but I would say that that's how well our discussions went in the last 2 days. So a couple things just to add. We'll be mindful of the broader financial and economic context when we make the decision on timing, and we always want to use our tools to support macroeconomic and financial stability. We want to avoid adding uncertainty to what's a highly uncertain situation already. So all of that will go into the thinking of the timing around this. In terms of the,
you know what? I should just move this over here so that
I don't want to get too much into the details.
Track my position.
We're literally just finalizing them. But the framework is going to look very familiar to people who are familiar with the last time we did this. But it'll be faster than the last time, and of course it's much sooner in the cycle than last time. But it will look familiar to you, and I would also say that there'll be I'm sure there'll be a more detailed discussion of our in the minutes to our meeting that come out in 3 weeks, where I expect that it will lay out pretty much the parameters of what we're looking at, which I think will look quite familiar.
Thank you. Let's go to Michael McKee at Bloomberg TV.
Mr. Chairman, since September of 2020, you've been operating on a monetary policy framework that let the economy run hot to bring unemployment down. That seems to be over, but I'm wondering how you would describe your reaction function now. What is it that the Fed is trying to do other than bring inflation down? In other words, is it we're going to keep raising rates until it comes down to an acceptable level?
Yeah, so I want to clear one thing up again. That is that nothing in our new framework or in the changes that we made has caused us to wait longer to raise interest rates. What we said in the framework changes was, and this was really a reflection of what had happened for the preceding couple of decades.
Saying we delayed it because of COVID, not because of our framework. Yeah.
Low unemployment, high employment, but we don't see inflation. Then we're not going to raise rates till we actually see inflation. That's what we said, and that was the sense of it. There was no sense in which
that's
if we got a burst of really high inflation, we would wait to raise rates. That's simply not in quite the contrary. The framework is all about anchoring inflation expectations at 2%. So I do hear this, that the framework we can't blame the framework. It was a sudden, unexpected burst.
He's taking real exception to that one, isn't he?
And it was what it was, but it was not in any way caused by or related to the framework. So come to today. I think our vision on this on the committee is very, very clear. What we see is a strong labor market. We see a labor market with a lot of momentum, great job creation, and we see the underlying economy strong. Balance sheets are strong. Yes, there are threats to growth from what's going on in Eastern Europe, but nonetheless, in the base case, there's a pretty broad expectation of strong growth. But inflation is far above our target, and the help we've been expecting and other forecasters have been expecting from supply side improvement, labor force participation, bottlenecks, all those things getting better, it hasn't come. And so we're looking now to using our tools to restore price stability, and we're committed to doing that. And you see that, I think, in the summary of economic projections, and you see that in the decision we make, and you will continue to see it in the decisions we make going forward.
If I could follow up by asking, I guess what you'd call it is the Paul Volcker question. You don't think unemployment is going to rise significantly, but if it does that temper your desire to keep raising rates?
No.
Well, the goal, of course, is
He's not going to say it like that.
restore price stability while also sustaining a strong labor market. We have a dual
It's like,
mandate.
don't say that I'm going to put people out of work. Don't say it. Don't say it.
Price stability is an essential
I don't like what he's saying here.
precondition, really, for achieving the kind
They're fighting over it. They're fighting over it.
a strong and sustained labor market. We saw the benefits of a long expansion, a sustained labor market. It pulled people back in, and there were
Russian naval shelling near Odessa is increasing, says U.S. official.
the pandemic arrived. It was just a completely exogenous event. So that's how we're thinking about it. We of course want to achieve price stability with a strong labor market, but we do understand also that really you can't have maximum employment for any sustained period without price stability. So we need to focus on price stability, in particularly because the labor market is so strong and the economy is so strong. We feel like the economy can handle tighter monetary policy.
Thank you. Let's go to Brian Chung at Yahoo.
Hi, Chairman Powell. Hopefully no tech issues here on this front. Wanted to ask just kind of the broad question about how you are communicating what the Fed's doing here today to the average American who might not be reading the dot plots or understanding what the SCP is. How is the 25 basis point hike today and then the signaling on future Fed policy going to address the inflation that they're feeling at the stores on a daily basis?
Sure. So I guess I'd start by just assuring everyone that we're fully committed to bringing inflation back down and also sustaining the economic expansion. We do understand that these higher prices, no matter what the source, have real effects on people's well-being. And really, high inflation takes a toll on everyone, but it's really especially on people who use most of their income to buy essentials like food, housing, and transportation, where, we've all seen charts that show if you're a middle-income person, you've got room to absorb some inflation. If you're at the lower end of the income spectrum, it's very hard because you're spending most of your money already on necessities and the price is going up. So, but it's punishing for everyone. So it has been a difficult time for the economy, but we do anticipate that inflation will move back down, as I mentioned earlier. It may take longer than we like, but I'm confident that we'll use our tools to bring inflation down. And you ask about rates. So the way that works, I would explain, is as we raise interest rates, that should gradually.
This is a little impulsive of a move there.
Interest-sensitive parts of the economy, and so what we would see is demand slowing down, but just enough so that it's better matched with supply, and that will bring inflation down over time. That's our plan.
Thank you. Let's go to Jolene Kent at NBC News.
Hi, Chair Powell. Thank you so much for taking my question, doing this today. My question is a follow-up to what Brian just asked. What is your message to consumers out there who can no longer afford the basics due to this high inflation?
Well, that is, yes, indeed. I mean, as I just said, I think we do understand very much, and we very much take to heart that it's our obligation to
In all honesty, at this point, I can't even remember what it was that I saw that initially got me into this move, but so far I've been able to judge the range and the order flow really well for it.
Very high inflation was like.
So I don't know if I was just lucky or if I'm just getting good reads right now.
Not allowing this higher inflation to become entrenched and to use our tools to bring inflation back down to more normal levels, which our target is 2% inflation. So we will do that, and I just would want people to understand that. But the way we do that is by raising interest rates and by shrinking our balance sheet, and so financial conditions will become, at the margin, less supportive of various kinds of economic activity. That will slow the economy, while also allowing the labor market to remain very strong. And the good news is the economy and the labor market are quite strong, and that means the economy, we think, can handle interest rate increases.
And as a quick follow-up to that, obviously the Federal Reserve walking this very complicated fine line, trying to avoid a recession. For the consumers out there who
Trying to avoid a recession, huh?
What do you say to that?
Well, I say that our intention is to bring inflation back down to 2% while still sustaining a strong labor market. and that the economy is very strong. If you look at where forecasts are, people are forecasting growth that's strong within the context of U.S. potential economic output. And we expect that to continue. And to the extent the data come in different, then of course our policy will adapt. But we do believe that our policy is the appropriate one for this forecast, and we believe that we can bring down inflation. We believe that we can do so while sustaining a strong labor market. The labor market it's not strong in the ordinary sense of the world. We have not seen a labor market where there are 1.7 job openings for every unemployed person, or where if you add job openings to those who are employed, that's actually substantially a larger number than the size of the workforce, than the number of people who actually count themselves as in the workforce. So this is a situation
that
where
makes me a little bit happier.
is higher than supply, and when that happens, prices go up. So we need to use our tools to move supply and demand back in. We don't think we need to do this alone. There will be other factors helping that happen, but we certainly are prepared to use our tools, and we will.
And we will. That was a little ominous. That was a little. And we will.
Thank you, Michelle. Thank you, Chair Powell. Sorry to take you away from inflation for 1 minute. May I?
I'm going to use that one now in the future. I'm prepared to use my tools, and I will.
Central bank assets. Of course, that raises a similar risk for other sovereigns around the world and their biggest.
No, not that tool.
Any concerns about, in the long term, how this might affect the dollar's status as the preeminent global reserve currency? And in the past couple of weeks, have you had to deliver any kinds of reassurance to other central bankers around the world?
Well, so of course, central bankers around the world are generally very, very in favor of all of these sanctions. But let me say this: sanctions are really the business of the elected government, and that's true everywhere. So the administration and the Treasury Department in particular, and other agencies, they create these sanctions. We're there to provide technical expertise, but they're not. It's not our decisions, so I'm reluctant to comment on sanctions really much because again they're not for us. We have a very specific mandate, and these are really the province of elected governments, as I mentioned.
And getting out on that one.
I'd have to leave it at that. Sorry.
No, it moved a little bit too fast for me there.
Let's go to Nancy Marshall-Genzer at Marketplace.
I was kind of worried that they would pop up and then come back to like that. Because they kind of, the way that they took those, it didn't really seem like it actually had the volume behind it. So I was a little worried that it would flip back on me.
Price spiral.
I got it. It was okay. It wiped out that bad lizard that I had, right?
The way I would say it is
that one had 11 ticks favorable. That one had or adverse, and that one had 11 ticks favorable.
You know, that's how.
So overall, pretty good trading today.
Over time,
on Sim at least.
Generally, it's driven
over the Sim trades
by rising productivity.
Wouldn't dream of trading this live. This is just crazy stuff.
The wage increases that we have. We look at we're blessed with a range of measures of wages that all.
I don't know. Did I get lucky, or am I just that good? What do you guys think?
Same thing, which is that the increases, not the levels, but the increases, are running at levels that are well above what would be consistent with 2% inflation, our goal, over time. And that may be, we don't know how persistent that phenomenon will be. It's very hard to say. And that's really, I think, the sense of your question.
The 30-year is at one point came back really, really hard.
Entrenched in the system. We don't see that. You can see, for example, in some sectors that got very high wage increases early on, those wage increases look like they may have slowed down to a normal level, but it comes back to you know what I'm saying here, which is there is
yes, I understand what you are saying here.
Supply, particularly in the labor market, and that is leading to wages moving up at ways that are not consistent with 2% inflation over time. And so we need to use our tools to guide inflation back down to 2%. And that would be in the context of an extraordinarily strong labor market. We think this labor market can handle, as I mentioned, tighter monetary policy, and the overall economy can as well. But yes, wages are moving up faster than is consistent with 2% inflation, but it's good to see them moving up, but it wouldn't be sustainable over too long of a period to see them moving up that much higher. And that's because of this misalignment between supply and demand. We expect to get more labor supply. We did last time. We got more than we expected during the last cycle. This time we've gotten much less than expected. So it's not easy to predict these things. But we do expect that we'll get people coming back in the labor market, particularly as COVID becomes less and less of a factor in many people's lives, something we all wish. So that's how we think about it.
Thank you. And for the last question, we'll go to Don Lee at the LA Times.
Hi, Chair Powell. I think you said to the Senate earlier this month that in hindsight, the Fed should have moved earlier. And it sounds like today that you don't think that the Fed is late. And I just wanted to get your clarification on that. And if it is,
This should be an interesting answer.
the Fed is behind the curve, how much behind the curve is it?
Right. So we are not. We don't have the luxury of 2020 hindsight in actually implementing real-time decisions in the world. So, the question is, the right question is, did you make the right decisions based on what you knew at the time? But that's not
I think
the
he
question I
did.
was answering, which is knowing what you know now. So I think if we knew now, of course, if we knew now.
No, I don't think he did. I think he made an okay decision, but I would have made a different decision.
Resulting from them in collision with very strong demand. If we knew that was what was going to happen, then in hindsight, yes, it would have been appropriate to move earlier. Obviously, it would be, but again, we don't have that luxury. And then but that's a separate question from your other question, which is behind the curve. And I don't have the luxury of looking at it that way. We have our tools, powerful tools, and the committee is very focused on using them. We're acutely aware of the need to restore price stability while keeping a strong labor market. And what I saw today was a committee that is strongly committed to achieving price stability.
That came back quite a bit there.
And prepared to use our tools to do that. We're not going to let high inflation become entrenched. The costs of that would be too high. And we're not going to wait so long that we have to do that. No one wants to have to really put restrictive monetary policy on in order to get inflation back down. So frankly, the need is one of getting rates back up to more neutral levels as quickly as we practicably can, and then moving beyond that if that turns out to be appropriate. And as you can see, it is appropriate in the sense to people's SEPs. They do write down levels of interest rates that are above their estimate of the longer run neutral rate. And there's also a range of estimates too, as you will see if you look at the details of the SEP. But thanks for your question.
Okay, that should be it, right? Yeah, that's it. I'm always anxious to mute it, because if I don't mute it on time, then their music plays on and I'll get the copyright strike sometimes. So, or I have in the past. So, see if I can get the camera to turn back on here. Maybe. Oh, no, I have to plug it in. Hold on. Well, So what are our takeaways here today? There we go. Now we're back. I have to say, this was a very, very interesting Federal Reserve meeting. I tend to find that when I take a trade during the Federal Reserve and I'll say like, oh man, this is really bad, and I'll short it, and then like that's exactly where it reverses and it comes all the way back. That sort of a thing. That is not necessarily all that unusual, right? But the thing that I found interesting, the Federal Reserve's economic outlook is very different from the market sentiment at the time. I wouldn't necessarily say it's different from like Wall Street analyst expectations, because even though there are some risks out there, I think that the analysts are also still saying that, hey, growth is still pretty strong. And even though we're having a little bit of a speed bump here, they don't think that we're going to have a recession. For instance, Goldman Sachs says chances of a recession are 35%, right? And when they asked Powell about that, he said, I don't think that the chances of a recession are exceptionally high here, right? So, their projections, I'm not going to say that their economic outlook should be surprising to the market. But it is definitely differs from the current market sentiment. And I found it really interesting that when he started talking about that markets did react to it as a kind of this saying that this really is coming in as a vote of confidence. I mean, of course, the Federal Reserve is doing this because they're concerned about inflation. And they do believe that the Ukraine crisis has put more pressure on inflation, and that inflation is likely to run higher and longer than they initially anticipated. But it's still, the raising rates here, he's really giving it a vote of confidence that, we can raise rates and the economy will be just fine. So I heard an economics professor say that they must raise the interest rate above the inflation rate to squash it down, as the US did in the 80s. Well, okay, so if you're saying that inflation will continue to be a problem until interest rates get above the current yearly inflation rate, which is like north of 5 to 10% right now, probably not. Probably not. I would hope not. I would hope that's not the case. But yeah, they're going to get the short-term rate to 2% for sure. For sure, it's going to get to 2%. I think that the neutral rate is at least around 2%, if not higher than that, depending on how other things in the world go, like this war and so forth. So, But I found it really curious how the market reacted to some of his comments, and it seemed like some of the the strongest reactions were on his comments that things are going pretty good, you know? So, I don't know. But other than that, for me, in terms of my projections about interest rates and everything, I do think there is a pretty good chance that we will get a 50 basis point hike next in May. I guess we get 2 months now in May. Of course, that's going to very heavily depend on the economic data, right? And the data that we got, from the last inflation reports and jobs reports didn't really kind of answer the questions, I think. So we give it another 2 months and see where we're at. If we continue to see high inflation readings from these reports, then for sure, yeah, maybe we will see that 50 basis point hike, right? But here again, I think even a 50 basis point hike, I think that the market can handle it. It's just the assets that are like exceptionally overvalued won't be able to handle it, right? Well, so I can see Bitcoin tried to pull something out here, and it has actually kind of ended up a little bit higher here, but they may just be following the S&P 500. They still look very, very correlated to the other risk assets. The Treasury's kind of peaked there at the end of his speech and have been coming back down since then. So I don't know where that's going to go. Okay, whatever. While we were talking, the White House has started to call Putin a war criminal. So I don't know what that means for the crisis in Ukraine, but that is kind of an interesting one, an interesting storyline that I think we should keep an eye on. I'm going to be interested to see which of his comments the news headlines come out with, because the Federal Reserve meeting is one of the biggest news events that we get today. But if I was the one writing the headlines, I wouldn't even know what to put to try and get people to write it. Well, actually, I am writing the headlines because I'm going to make a TikTok. I don't know what to put down. But hey, you know what? In the end, of course, we got 30 minutes left. I don't think that I'm going to wait the 30 minutes. I think I want to get back to what I've been doing. Get back to work and check on the child who it sounds like my mom has been able to calm him down, but I think my mom wants to get going. So but we'll see. Like, you know, often it takes them a few days to really sort out what the impact of all of this really truly is. I do kind of have to wonder if the market is not being a little bit too aggressive, but I think that the prices that we're trading right now are perfectly fine based on what we know for now. So I will see you guys tomorrow morning. Oh yeah, you know, I should also talk about my performance, right? Well, earlier in the day today, I did take a trade that kind of got short-circuited and I got out. If I had stayed in that trade, that would have been great. I mean, come on. That was almost 40, actually, it would have been like $400 if I had tried to swing it, but there's no way that I'm going to try and keep that on. So that one got short circuited by trade. This was a good short in the S&P 500, but I did market making to get that out. You know, 123 ticks favorable excursion, though that was a good trade. I was making a good call there in the end, although there must be some luck to it because it took a really long time for that one to actually come down, right? This trade, this was great. I think I don't wish that I had only done one contract and gotten the 4 ticks, but it is fine. That one's good. That one was good. This one, you know, I took the loss on it. Probably didn't need to. Probably could have held on to it, but I was just too slow on that one. I should have dumped that way faster than I did. But then I made back. This one's fine. Well, this is kind of just like there's a lot of volatility. So maybe those results there are just random. Just in case you're ever thinking about, you know, trading FOMC, right? That's the sort of thing that will tend to happen to you. So I'll see you guys tomorrow. Stay profitable.